Hello, everyone, and welcome to today's webinar, Prepare Well to Exit Well, a primer for business owners. Before we get started, I would like to go over a few items so you know how to participate in today's event. You have joined the presentation listening using your computer speaker system by default. If you would prefer to join over the telephone, just select phone call in the audio pane and the dial-in information will be displayed. All attendees are in listen-only mode. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the presentation, and we will collect these and address them in the Q&A session at the conclusion of the presentation. Today's webinar is being recorded, and a copy of the audio recording, slide deck, and handout will be emailed to you within 48 hours of the completion of this live presentation. And now I would like to pass the presentation over to John Selbeck. Go ahead, John.
Good morning, everybody. This is John Selbeck from Whiteford, Taylor & Preston. I'm a corporate and M&A partner at Whiteford. For those of you unfamiliar with our firm, we're a full-service law firm of about 180 lawyers with 16 offices throughout Virginia, DC, Maryland, Pennsylvania, Delaware, and New York. I have worked with Transact Capital, Steve Zacharias, and Jonathan Brabrand for several years at this point. We have a good relationship, and they reached out to me recently suggesting this presentation from Jonathan, which I thought was an excellent idea. I find that my longtime clients facing an exit event often don't do enough planning for that exit, and so I thought it'd be very helpful. And as part of thinking through that, I thought of SEMA Financial Group and Mark Jones, who I've known a long time, and we've done a lot of work together as well. So I invited Mark to join this presentation and present it together with my firm, and to then let Transact Capital and Jonathan give his presentation, which I hope everybody finds useful today. So with that having been said, I'll turn it over to Mark, who will then introduce and turn it over to Jonathan. Thanks, Mark.
Thank you, John. Hi, I'm Mark Jones. I'm with SEMA Financial, and we started as a CPA firm, but we do a lot of financial services and integrate them around retirement plans, benefits, consulting, tax work, that type of thing. And throughout my years in working with business owners, you generally find two different types of business owners. You find a lifestyle business owner that has a job, a business, and it's a job to them, and that's what they do their whole career. But most of them are in business to sell a business, and that's where it all gets a lot of fun. And it takes a lot of planning, it takes a lot of thought, and you've got to do things the right way to get the outcome that you want. And so hopefully, working with Jonathan Brabrand and Transact Capital, that you can take away some things in a Q&A at the end that'll do it. So with that, I'll turn it over to Jonathan.
Great. Well, thank you so much, John and Mark, for hosting this event today. I'm really excited to be with you all, and welcome to all who've joined. We're going to jump into the presentation here. I think by introduction, I'm a managing director at Transact Capital Partners. We're a full-service boutique investment banking firm, really focused on helping business owners when the time comes to exit, getting ready for that exit, and then having a successful exit. And that's what we're going to be talking about today, is preparing well to exit well. And the audience for this presentation is really any business owner, regardless of where you are on your timeline. It could be an exit, could be right around the corner, or it could be miles down the road, but there are things that we'll be talking about today that I think will be valuable and helpful for you, regardless of where you are on that timeline. So if we go to the next slide, the first slide here, you'll see this is just a reminder that 100% of business owners will exit their business at some point. It's a certainty. It's like death and taxes. It will happen. The question is, though, is it going to be on your terms or on someone else's terms? Is it going to be at the peak and at a point where you're excited about that? Or is it going to be when your back is against the wall, when you're being forced into it by factors that are outside of your control? And the goal for this presentation is to help make sure that when the time comes, and we'll talk about how to know when the time comes, that it's on your terms and you're feeling confident and feeling like you're going out on top not being pushed into it at a suboptimal period. So the next slide are the two questions that we're going to be talking about today. One is the concept of sale readiness. Are you ready for a sale? Why would you want to be sale ready? What does it mean? And the second one is, how would you know when the right time comes to exit, which is a critical part of the decision-making process. So we'll touch on those here as we go along. On the next slide, taking a step back, what are some of the triggers that I've seen? These are some of the triggers that I've seen that have brought my clients to the sale table. What has driven them to want to exit their business? These are a sampling of the reasons that I've seen over the last 20+ years of working with business owners. And there are no surprises here. We've got retirement, planned retirement. We've got health issues that may lead them to want to exit, industry pressures that are pushing them to expand or be left behind, and to partner up with other strategic partners that can help them have a better position in their marketplace. Family dynamics, whether that's a change in the owner's immediate family or changes in the planned succession to children or others. Changes in family dynamics often will trigger an M&A process. And lastly, and perhaps more often than you would think, an unsolicited offer from a potential buyer that just comes out of the blue is what brings the business owner to consider an exit process. The key theme for all of these that I wanted to highlight here is they all put the business owner in a reactive state. These are all things that happen to a business owner that they need to respond to them. So these are things that are coming that are unforeseen or unexpected, and the business owner must react. And that, I think, is really the core of why I think it's so important to be sale ready, so that if one of these things were to occur, from a positive side or from a negative side, you as a business owner would be able to respond, sure-footed and with confidence about how you'd want to proceed. So the next slide, we'll talk about at a very high level, and I think one of the strengths that our firm has is helping clients simplify what can be sort of overwhelming optionality and a broad range of choices into something that's more manageable and understandable. And so the exit option landscape may seem overwhelming and daunting, and so the purpose of this is to help you think through and simplify what these options are. And I'll add that we encourage our clients to be open-minded around all these different options that we'll touch on here, not to necessarily pick one right now, but just to be aware of what the choices are and be thinking about the pros and cons of each and how they might fit into what you want to achieve through an exit option. But if you look at the entire waterfront of exit options, you can boil them down into internal and external. And within each of those categories, there are two subcategories. So in internal, we have family members and we have employees. And employees could be one or more key leadership employees, or it could be the entirety of your employee base through something like an ESOP, an employee stock option program. The benefits of internal exit options, employees and family members, is that there's a high level of trust and familiarity with these groups. You know them very well. You have a high degree of trust in them, or you wouldn't be considering them for an exit. And they likewise have a high degree of familiarity and trust with you. The 2 points that we need to make sure we're cognizant of are, one, oftentimes neither of those groups have substantial capital to be able to fund a significant liquidity event at closing. They don't have the capital to buy your business outright. And so we often see structured purchase agreements over time where the price is staggered into the future, and you are receiving proceeds from the sale to your family member or employee over time. And that's assuming that you want to have a liquidity event. Sometimes with family members, it's really more of a transition as part of estate planning, and you just want it to continue on in the family. So that's one. The second is being upfront and clear about whether there's an aptitude and a desire on the part of that family member or employee to take over the business. And you really need both. You need the aptitude to be able to have the skills and the mentality to run a business and to step into your shoes. And you need the desire to want to do that, even if the aptitude exists. And so being clear and understanding that, if your son or daughter, as an example, wants to take over the business and is able to take over the business, those are things to be, clear about, and not just assume that both of those things are the case. On the external option side, we have two subcategories there as well: private equity groups or financial buyers, and strategic buyers. And this is really where I spend the bulk of my time in my day job at Transact, helping business owners think about external options. And so the pros and cons here are essentially the reverse of the internal. External groups have the capital to fund a transaction, a purchase price at closing. They have the aptitude and the desire to do so, but they don't have that level of familiarity and trust that you would have with those internal options. And so part of the process that we run with clients is to help build that trust and that familiarity through the process, admittedly in a more condensed fashion, but that culture fit and understanding of where the future partner is thinking about taking the business, and the fit between the personalities is very important. It is one of the key factors that we look at in addition to just price when thinking about who the right partner would be. As you think about the differences between those two subcategories of external buyers, one other point to mention, an easy way to think about it: strategic buyers, these are companies that are already in existence in your industry or in a related industry. They have a strategic plan that they are working towards. And the question as they think about acquisitions of your business or others is whether that business, your business, furthers the strategic plan, the strategic path that they're on. So they're headed in a direction, and the acquisition of your business may further that strategic plan. And the degree to which it does will directly influence their level of valuation and aggressiveness around your business. And so the ideal position would be to find a buyer who has put a bunch of pieces in place for a plan that they're looking to achieve, and you're the last puzzle piece to make that plan complete. Those are where we see excess valuations, where they're willing to pay a premium to complete the puzzle that they're trying to build, and you're that last missing piece. We'll come back to that later. Private equity groups or financial buyers, the other part of the external group here. These are funds that have been, pools of capital that have been raised to invest in private businesses, help them grow, and then to achieve a return through a subsequent equity exit event in the future. Here, they don't have a strategic plan. They're evaluating your strategic plan and whether the capital resources and the other strategic value that they can provide to your business will help it grow faster and to deliver a better return than another opportunity that they may be considering. And so that difference in whether you're joining an existing strategic plan through the strategic buyer audience, or whether you're getting support, financial and otherwise, to continue your strategic plan where the financial buyer community offers that option. Those are two kind of simplistic ways to think about the benefits of those two different subcategories. All right, let's move on to the next slide. Here we're going to talk about really the three main drivers of being sale ready. So we talked about what does sale ready mean, and I would propose these are the three steps that you could be taking right now, regardless of where you are in your timeline, to become more sale ready. We'll talk about these very briefly. The first one, and perhaps the most novel of these three, is establishing industry relationships. This really involves reaching out to potential future partners in your industry or in a related industry, particularly ones that have been acquisitive, and just beginning a dialogue, getting on their radar screens, having a high-level conversation with them on an annual basis to help build some rapport and a history with these companies well before you need anything from them. There's a lot of benefits to this, and I'll hasten to add, the idea of talking to a competitor in your industry may be off-putting. I'm not suggesting any type of sharing of confidential information or anything that would put you at a disadvantage competitively. The content of the conversations that I'm advocating is really nothing more than could be found on your website or in the public press releases that they are making on their side. But it's really just developing that rapport and a history with these businesses, again, well before you need something from them. So that may look like reaching out to the corporate development person or the CFO of a publicly traded company in the industry that has made acquisitions and telling them a little bit about who you are and what your business is doing and where you're headed. Again, very high level public domain type of information, and asking them questions around what they're looking for in acquisitions, what drove them to have an interest in the last acquisition or two that they made, how that acquisition is going, and just to get, again, the conversation started. The benefits here are really twofold. One, you can pick up bits of information from those conversations that may impact and influence your strategic direction today. So if you find out that one or more potential future strategic buyers really like X, Y, and Z, or are looking for X, Y, and Z in their business, that could be good information for you to know as you think about where to take your business. It's always good to create something you know a future buyer would want, rather than just create what you think would be attractive and hope someone will be interested. We don't advocate using this kind of anecdotal feedback to have a complete course change in where you're headed, but it can be helpful in the margins to influence a decision that you might be making. Secondly, that level of rapport and history that is being built over time through this strategy will help you immensely when the time does come to exit. Imagine the difference in the conversation if you were to hire an investment bank. They were to, in the future, when you're ready to exit, they make a call to that strategic buyer, and one of two things happens. One is, oh, I'm so glad you called. I've been really enjoying tracking the history of that business, your client, over time, and I'm really excited that now there's an opportunity to actually talk about a way that we might be able to partner together. I'd love to see the information that you've created. This is sort of the opportunity that we've been looking forward to. Versus, I've never heard of that company. It sounds interesting. Send it over, and I'll kind of get around to it. But I don't really know anything about that business. It's sort of it's an unknown to me. You can see the benefits of the first versus the second, and that can really go a long way in the exit process to have some established relationships. Again, 3 or 4 or 5, not a ton, but we've seen where this strategy has really benefited clients both in the near term and in the long term, and is one that a lot of people, I think, are not doing. Strategic planning is the second way to become more sale ready, and I'm sure many of you, if not all of you, are doing some type of strategic planning. As you may know, there's a wide range of planning, from very simplistic and free to very extensive and expensive. I have no preference on either end of that spectrum. What I would suggest is that whatever type of strategic plan that you choose, it really just meets these 3 basic criteria. 1, you're making an annual plan for what you want to do in the next year with your business at that kind of high level. 2, you're tracking results to that plan and taking it seriously. And 3, you're reporting out the plan and the results to plan to someone outside of your company. That could be a spouse, that could be an attorney, that could be an accountant, a trusted financial advisor, an investment banker like me, but someone who doesn't already know all of the things about your business, isn't in the details with you, and needs to hear it from you. And the benefits to these are a couple. 1, it gets you in the habit of thinking at this kind of strategic level and communicating it, your wins and your losses against plan, to someone outside of your business. That's the type of way that we need our clients to be able to describe their business when the time comes to potential buyers. And so it gets you in the habit of presenting in that mode and thinking about your business at a high level, a step or 2 above the day-to-day hand-to-hand combat. It also creates this history of plans that we can use to create the information memorandum when the time comes to exit. And that current plan that would be in place when you decide to exit can really help shape where your business is and where it's headed. one of the misconceptions about the types of memorandum that we write about our clients is that it's all historic and backward looking. And really it's weighted pretty 50-50 between the history and the future. Buyers are buying the future, not the past. So they're really focused on the growth opportunities and where your company is headed. They obviously put a lot of weight in the history of your business, where you've come from, but that's really to assess whether they believe where your business will be headed and what you're saying about the future. And so keeping in mind that it's really important to think about how you're describing the opportunities in the future, and we'll come back to the idea of positioning in a few minutes. But this practice of getting into the habit of thinking strategically in the next year or two, tracking results against that, and reporting out to someone who isn't familiar with the details can really help strengthen your practice in doing so, and create this this trail of plans that can help you when the exit process begins. And the last one is having a succession plan in place. This goes to something Mark was mentioning in his introductory remarks, the difference between having a job and owning your own job versus owning a business. And the difference is whether the business can run without you or not. And obviously, a job is not really sellable. It provides current income, but when you stop wanting to do that job, there's really no value left in it. Whereas a business that can run with you slowly taking steps out of the day-to-day has real value. It has intrinsic value in addition to the current income it provides while you're in the business. And so having a succession plan, and whether you're at the early stages of that or in the final stages that are totally handed over day-to-day operations of your business, is less important than just having a plan. So we see businesses that have a plan in place where the owner is still involved, but he or she has named a successor and is grooming them, or has a couple of lieutenants that they are keeping an eye on and believe that their successor is one of them, and there's a plan to work them into greater responsibilities and ultimately to take over. Those businesses are much more valuable to an outside buyer, strategic or financial buyer, because there's less risk, perceived risk from those buyers in the business when it's not still completely dependent on the business owner who's about to put, hopefully bunches of millions of dollars into their bank account and be suddenly less concerned about the success of their business post-closing, when that new buyer has all the responsibility. Having a business where the leadership has started to transition away from the owner makes that much, much less risky, and therefore much, much more valuable. So I encourage you to have, reach out to start developing some industry relationships, and we can help you think through in more detail how to do that. Have some type of strategic plan and a process for reporting out, and then really think carefully about a succession plan and how you would communicate where your business leadership will head as you want to step further and further off stage. The next slide we'll be talking about the timing. And so the other question we're going to address is, how will you know when the time is right to exit? And no one has a crystal ball. It's impossible to predict the future perfectly, but the best way I've seen to answer this question is really looking at these three characteristics and evaluating them subjectively on their favorability. And so first, we look at the M&A markets. Like you'd want to sell a house in an active real estate market, you'd want to sell your business in an active M&A market. The good news here, as John and Mark, and I'm happy to explain in more detail, the M&A markets are hot. They have been hot. They really continue to be hot through the pandemic, with maybe a month or two hiccup. And that's really, so you get a check mark there for the foreseeable now and for the foreseeable future. There are reasons behind that. There are systemic supply and demand dynamics where there's more capital chasing fewer deals. There are fewer privately held businesses that are ready to exit than there are capital to be able to invest in those businesses. And so it's a seller's market. It has been, and it will be for the future. Secondly is really taking a hard look and evaluating the outlook for the health and outlook of your industry. It is harder to sell an A+ company in an out of favor industry than it is to sell a C+ company in an in favor hot industry. So industry dynamics trump your company's performance. And oil and gas is a classic example of this. When oil prices are high, It's really easy to sell any type of business that is tangentially related to oil and gas and provides any kind of service that touches it. And the thinking is that the positive tailwinds that the industry is experiencing will benefit all of these companies in and around the industry. It's a rising tide lifts all boats. But when oil prices drop and the sector is out of favor, you can't give away an oil field services company because no one wants to be dragged down with the industry. So taking a hard look at what the outlook for your industry is, are there big changes on the horizon? Are there points of uncertainty? Are there changes that could be positive or negative to your industry overall? These are things to be thinking about and to be evaluating when you want to exit. Obviously, you want those to be neutral to positive and not to be exiting your business in a period where your industry is uncertain, the future is uncertain, or it's seen as out of favor. And the last one is your company. And here with the baseball analogy, you kind of want to exit in the 7th inning. You don't want to wait until the bottom of the 9th or in extra innings when your business has plateaued or is even declining to exit. You want to leave some significant, exciting growth ahead of the company. It's what we talked about before with buyers buying the future and not the past. You want to have a nice track record of growth and profitability and be coming off a period of strength with your company, but you also want to make sure that you don't wait too long, that you've got some nice growth ahead of you. So that's a key thing to be thinking about, is looking out and in the next 2, 3, 4 years, how is your company expected to fare, and making sure that that's a positive, you can really sell a positive growth story to future partners rather than one where it's plateaued or it's even starting to decline. All right, next slide, please. The second most question I get from business owners after when's the right time to sell is, how much is my company worth? And the answer is private business valuations are tricky. If it's a public company we're talking about, it's very easy to determine what the market price is for Apple or for Exxon or for any publicly traded company. It's the market cap that day of what the stock price is trading at, plus the debt that's on it, gives you the enterprise value for the company. But for private businesses, it's a lot trickier than that. And so there's a couple different ways that we talk about valuation. The first is this kind of scientific model. We have a business valuation service. There are many other firms that do as well. They use models to create a scientific kind of almost theoretical value for your business that involves looking at the future cash flows, discounting them back at some appropriate discount rate, looking at other deals that have traded in the market that are similar to yours and making comparisons, looking at how the public markets are valuing companies in your space, and applying those metrics to your business. So there are many models that can be used and are used to create sort of a theoretical value, a scientific quantitative value for your business. Next slide, though, will show that there's also an art to the business valuation as well. And this is really where we earn our living. It is going beyond that kind of scientific valuation and getting into premium valuations that exceed that. So if we were to run a auction process for a client that we're selling, and we got back 30 first round bids on that company based on the information that we shared, and we arrayed them by value, you'd see this sort of bell curve. You'd see a small number of very low values for that business. These are the tire kickers and the folks who are hoping to get a bargain. You see a bunch of people in the center with valuations that are really in that scientific kind of category. They are running the same models, they're using the same projections, and they're kind of coming out with a range that is where the bulk of the market is. And then you see this tail on the right, on the far end, with people who have gone beyond that base valuation. And if you hit the next slide, those are really the spike bids. Those are the ones where they see the same models, those buyers, but for some reason they're going beyond that. Those are obviously the groups that we focus on. Those are the ones we're trying to identify. And those are the ones that are reacting to the art of private business valuation. And these are things like being the last piece of the puzzle that they need and they're willing to pay a premium for it. Valuing your business more highly because of how the market will react to it, or the unique capabilities that your business plus their business will provide. And so it's not that they don't understand the scientific valuation, they have justification in their minds for going beyond it. And so when we talk to clients about valuation, it's really hard to put a high degree of confidence in how far out that tail, that spike bid will come. And so we often talk about, more of the mid point of that bell curve where we have a high degree of confidence that the bulk of the valuations will come in. But once we've aligned with our client that we think that would be a acceptable value for them, and we believe we have a high degree of confidence that the market will yield that valuation, we set that aside. And we go to the market and try to find those few spike bids that exceed that and really exceed the expectations of our clients as well. All right, next slide, please. Business owners want to, with coming off of that conversation around value, a quick follow-on question is, well, how do I increase the value of my business? And there's really two ways to do that in basic terms. One is to increase the magnitude of your revenue and, more importantly, of your cash flow, just to become bigger in scale, and I'm sure that you're all doing that. But the second is to reduce the perceived risk. And if you think about sort of Finance 101, one of those metrics that we just talked about, and it's called the discounted cash flow model, it really just looks at your future cash flows and discounts them back at a discount rate based on the perceived risk of those future cash flows. And you can see that increasing value would be either to increase the cash flow or reduce the risk. And so one way that you can think about improving the value of your business today is really take an outsider's view of your business and think about where are perceived risks in your business and its business model and working to reduce them. And that is a very tangible way to increase the value of your business without changing the magnitude of the cash flows at all. So examples here are when you hear people talk about recurring revenue is seen as more valuable, it's because it's perceived as less risky. Consistent cash flows, a strong management team, diversified customer base, not having one customer being too large of a portion of your revenue is perceived. Having customer diversity is seen as low perceived risk. Having customer concentration is seen as high. There's a number of different things in the handout that we'll provide after this webinar. We'll list some of those specific things, but thinking about increasing the value of your business is more than just growing the magnitude of its cash flow. It's reducing the perceived risk of it as well. Next slide, please. So we're going to shift here into maybe a little bit lighter portion and go through what I've seen are the top 10 M&A mistakes that people have made, and the goal is to obviously highlight them and to avoid them. So with number one, I'm no Dave Letterman, but we'll go through these here quickly. The first one is waiting too long. And I touched on that earlier when we talked about the 7th inning versus the 9th inning. Another quick thing to think about here is that business owners often think about an exit as the end of the line and something that needs to be delayed and delayed and delayed until the last possible minute. And another way to think about that is really a reminder that business exits really create a new chapter. They create new chapters for not only the business owner, but for the company and for the employees. And it's not something to be delayed and avoided at all costs. So it obviously creates a new chapter for the business owner and his or her family in what the capital and the proceeds from an exit can do for them in their next chapter of their personal and philanthropic and professional goals and ideals. It also can create a new chapter for your company in where it can grow and what new opportunities it creates for the company in partnership with a new financial buyer or a new strategic buyer. And a lot of business owners take real pride in seeing their business grow much faster or more expansively than they know they could have done it on their own. And that's a secondary benefit from that exit. And thirdly, it provides a new chapter for your employees. We had a client recently that had a key employee that they were really worried about losing because they kept giving them more and more responsibility, and this woman just kept taking it and knocking it out of the park. And there was a point where the business owner was like, I don't have anything more to give her. She's doing everything I've asked for, and I'm worried that she'll get bored and leave. And one of the outcomes of the sale process that we went through was the business was acquired by a much larger family-held business. And suddenly now there are multiple layers of development and growth opportunities for that key individual that he could never have given her on when the company was a small standalone business. And so it really opens up new chapters for your employees, in addition to the company, in addition to your family. And so it's something to be thinking about more as a beginning of new chapters, not the end of the line. The second mistake here is a lack of succession plan. So we talked about that already, but it's really important to have someone lined up or a plan to take over the responsibilities that you maintain in your business today. And the more you can do that, the more valuable your business will be. Again, it's just another way of reducing perceived risk. The third one here is poor positioning. So positioning is really describing how you want to communicate what your business is to the marketplace. And that is really something that's within our own control. You can describe it however you want, as long as it's intellectually honest. But the goal here is to be more expansive and not so restrictive. An example that I use in a book that I wrote earlier this year focuses on Capital One, a company we're all familiar with. Capital One, despite being one of the largest credit card issuers in its early days, and now one of the largest banks and financial institutions in the country, describes itself as an information-based marketing company, not as a credit card company. And that's an example of expansive positioning. They would say that what they're good at is using information to market to consumers, and the products that they choose to do that with have been credit cards and now are other things. But you can see by defining themselves that way, it opens up much more opportunities for growth than just being a credit card issuer. And I encourage our clients to think that way when they go to describe their business to the marketplace through the process, through the sale process. And it really goes to expanding the growth opportunities and planting seeds in the minds of buyers about all the different ways your business can grow, even if they are objectives that you're not actively pursuing, but that just, again, are intellectually plausible, and that we can make a case for why your business could grow in that direction if a new partner wanted to take in that direction. Those things can really add value and attract a broader universe of buyers. And so the mistake here is to think too narrowly, too focused on how you describe your business. The fourth one is a lack of preparation. And this is an area where the folks at Whiteford and at SEMA and others can really help you get ready. This goes to everything from having corporate documents in line, having your financials in good shape and reviewed or audited or compiled, depending on where you are, is really, really important. Thinking about the things that the business buyers will want to see and have been locked down, and getting those set ahead of time. If you have a physical plant like a manufacturing or distribution facility, can also mean literally cleaning up and improving the physical layout of your company as well. But there are a lot of things that you can be doing to get ready that are also good business practices, but will facilitate a smoother transition when the time comes to exit. So getting those things ready ahead of time is important. The fifth one here is avoid prejudging buyers. It's really, really hard. I've been doing this for over 20 years when we start a process with a new client, to know with certainty who the final buyer will be. Our clients often have a guess. We sometimes have a guess, and we're both often wrong. And so the goal here is to avoid prejudging buyers and keeping them out of a process before you get a chance to give them a chance to prove themselves. There are points along the process where you can kick out buyers if they come up short on valuation, or if you learn something about their culture or their management team that is not a good fit for you. The process that we run is really a two-way interview where they're learning more about you and you're learning more about them. But if you don't allow them in the process to begin with, you'll never know whether they were a good fit or not. And we've seen examples time and time again where a buyer that our business owner was sort of lukewarm on at the beginning kind of rose to the occasion and became a great partner for them at the end, and vice versa. Someone that the business owner was really excited about at the beginning kind of underwhelmed us through the process and ultimately was not a good fit. The mistake number 6 is to identify avoidable surprises and try to get ahead of them. So the handcuff here is a reminder of probably the best example of this in my career was we were selling a really, really high quality distribution business from one private equity owner to another. We were about 2 weeks away from closing after having gone through a multi-month process. And I get a call from the buyer who says, did you know that the head of sales for this business that we're about to buy is a convicted felon and had served prison time in the 80s for cocaine distribution? We did not know that, and that was an avoidable surprise that completely derailed the process in the 11th hour, despite the fact that that executive had signed a consent for the background check that ultimately identified his past criminal record. The point of that is, assume that buyers are going to get to the bottom of issues or negative surprises, and get out ahead of them. And preferably while you still have more than one buyer at the table, so you can gauge their reaction and kind of factor that into who you select and have that be part of the competition, rather than waiting until the final moment when they uncover it themselves, because then you've got to deal with the issue, but you've also got to deal with sort of a breakdown of trust and clarity, that communication that the buyer will start to second guess if they have to find out it on their own. The seventh mistake is an overemphasis on price. So obviously the reason we sell businesses is for the purchase price and to maximize that. But there are many cases where I've seen clients, I think, correctly pick their final buyer as the second or third highest bidder, not the top. And there are a number of reasons why they would do that, ranging from cultural fit, terms and conditions of the price, where how the employees will react to the new owner, how their legacy will be managed through the process. There are just a lot of intangibles that we have our buyers compete on, rather than only price, to make sure that we're getting the best overall deal for our clients, and not simply the highest price. And so making sure to think about how you pick your final partner more holistically than just the top bidder is really, really important. And when you're in a tight margin around the top few bidders, there are some other factors that really, really play an important factor in the success of a transaction, not the least of which is just an agreement on how the business owner's role with the company post-closing will be, and making sure you have complete alignment on that, among other topics as well. The eighth one is a lack of strategic plan. So here it's what we've talked about before, making sure you have that plan in place, that you've been tracking it, and that you can communicate it effectively and convincingly to buyers about where the business is headed, is critically important in achieving a premium valuation. Number 9 is a lack of negotiating leverage. So it's really, really hard for a business owner to negotiate effectively the best deal possible with one buyer on their own. Presumably that buyer has made other acquisitions, they're more adept at it. And if you think about that bell curve I described earlier, if there are 30 buyers from low to high, how do you have confidence in knowing that you're talking to the top bidder or one of the top bidders versus a middle buyer or one of the low buyers? And so it's really difficult to do that without some other buyers at the table. Having an M&A advisor like Transact or others out there is one way to provide negotiating leverage, whether we're actually contacting other buyers in a competitive process or we have the threat of going to other buyers if we need to. That can be a compelling source of negotiating leverage. But doing it on your own with your only leverage point being to walk away from the deal is not as strong. You obviously do always have that option, but if one of those triggers that we talked about at the beginning is happening, that may not be a credible threat. If you're having health issues or industry pressures and the clock is ticking, you may be forced to take the best deal you can get on your own, versus having an advisor and some competitive negotiating leverage to really help you maximize the outcome with either that buyer or another buyer. And the last one, number 10, is having an overly complex deal structure is a mistake that should be avoided. Attorneys, accountants, and investment bankers, your hosts here today, are probably guilty of this more often than not, though our 3 specific firms, I'm sure, are never, around creating a deal structure that becomes overly complex and has more and more features and eventualities that need to be addressed that can sometimes just bog down the transaction to the point where it's just not worth moving forward. Buyer and seller fatigue sets in, and ultimately the deal just sort of kind of peters out. The rule of thumb here is that you should be able to describe the deal, what you're receiving for selling your business, in a way that a middle schooler could understand, maybe without the dollars and cents, but here is what I'll be receiving either at closing or in the future based on these specific things, whether it's a seller note or some type of contingent purchase price called an earnout. I know exactly what will trigger the payment of the exact amounts that I'll be getting, or the formula for what I'll be getting, and there's no uncertainty. That is the goal, have a clear, crisp, understanding of what you're selling your business, and not allow the complexities to overwhelm, an otherwise successful transaction. So this last section, I thought it might be helpful before we turn it over to Q&A real quick, is just to give a quick snapshot of what the M&A process looks like. Again, you may be thinking about this in the near term or in the long term, but it's sometimes seen as something that's opaque and hard to understand. And my goal here is to shine a little bit of light into it to make it a little bit more easy to understand and simple to grasp. So this next slide, pretty much any M&A process that you go through has these three phases, phase 1, phase 2, and phase 3. They typically take 2 to 3 months at a time. So if you add that up, it's typically a 6 to 9 month process. There'll be more detail in the handout on what's in each of these phases, but essentially phase 1 is the preparation where you are working with an investment bank to help, or an M&A advisor to help create the marketing materials that will describe your business. And we talked about those being both future oriented and historical as well. And the list of buyers or partners that they'll be contacting on your behalf. When those things are complete and you've approved them, we move into the second phase where we actually take those materials, we actually call those buyers that you've approved. If they're interested in learning more, they sign a non-disclosure agreement, and then they receive those materials that we've drafted on your behalf. They all review them for a period of a few weeks and then give first round bids in terms, they're called indications of interest, and kind of gives us a sense of who's looking at the business more aggressively than others. That's that bell curve. The second part of the phase 2 is where we select the most aggressive bidders, and by we, I mean the client, to meet with and to actually have in person or in these days, sometimes Zoom, face-to-face meetings where they get to understand more about the business and hear it directly from you, and you get to learn more about why they're interested in your business and the strategy that they have for the combination. And ultimately, after those meetings and some more information is shared, they provide a final bid for the company called a letter of intent. We help analyze those offers. The goal is to have multiple offers from different types of buyers for you to choose from, and ultimately you select your buyer and we negotiate and execute an LOI. And that begins phase 3. And that's really where the investment bank, in conjunction with your attorney and your accountant, get through the closing process, which is 2 parts. One is the due diligence process, where they're asking a bunch of questions and using third-party advisors to really understand all aspects of your business, and we help to manage that. And the second is the documentation process, where we and the attorneys, yours and theirs, document and negotiate the actual closing documentation to affect the transaction. And the process ends with the signing of those documents and the closing of the deal. The next slide just shows that there is a variety of types of processes that you can run based on the number of people that you want to include in your process. So those 3 phases can be run with one group, with a small handful of buyers, or a very broad process. And the handout will have some of the pros and cons of these. I think it's sort of intuitive. Speed is one factor. It's faster to go with one buyer than 100. Confidentiality is easier to maintain with one group versus 100, but your certainty that you're getting the best price is low with one buyer and high with a broad process. And ultimately, we typically run those targeted processes, kind of the best of both worlds, where you're moving relatively quickly and you're maintaining a high degree of confidentiality, but you're getting competitive process and a degree of confidence that you're maximizing the price for your business. All right, that brings us to the next slide, which is really the culmination. I really appreciate the opportunity to speak with you. We're going to shift now into a Q&A period. Before we do that, this is my contact information. I'd be happy to have a confidential 30-minute consultation with any of you to talk more specifically offline about any questions you have about this presentation, or if you have questions just around where your business is along that spectrum, or something you want me specifically to address, I'd be happy to do that. Shoot me an email and we can set that up. So with that, I will turn it over to some Q&A.
With Seema, one of Mark's Director of Communications. Thank you for all that wonderful information. Jonathan, we do have a couple of questions from the audience, beginning with this. In the last 12 months, this one attendee says they've received at least 6 inquiries via email regarding the idea of selling. Are there any tells as to which of these emails should be treated seriously and which should just be deleted?
Great question. We often get, it used to be a file folder that our clients would give us of all the outreach that they'd received leading up to a process, and they'd hand it to us to follow up with. Now it's emails. And if the client wanted us to, we'd follow up with all of those. And so our experience has been, there may be some good buyers in there, but there may be a lot of tire kickers. I think one of the telltale signs is whether you can tell whether they're an actual buyer or they are representing or hope to represent an actual buyer. And so there are differences between the two. You can understand the seriousness of the first and maybe the lack of seriousness of the second. Just because there are representing a buyer, they could still be legitimate. There are buyers that use buy-side search firms to reach out to companies to try to generate acquisition targets, and they seriously have a mandate and they are serious about buying business in that industry. Those are okay, but there are also some middlemen who are trying to find buyers on one hand and then run over and try to find sellers on another, and they're not really representing anyone. They're trying to create something. Those are the ones that don't really have a lot of value.
Should the business owner not respond to those? They should work through someone else?
Ideally, I would say yes, just collect them and have someone. I think it's more beneficial to clients to use a third party like us to reach back out to them, and then we'll quickly sort out, even if it's on an informal basis without engaging us, we can help sort out the seriousness of them. And we may be familiar with them to be able to tell you without reaching out to them, whether they're worth your time or not.
Wonderful. Mark, I'll direct this one to you. What things come up most often through a buyer's due diligence that complicates, delays, or overall lowers the purchase price?
As I sat and listened to Jonathan, which it was great, Jonathan, appreciate it. I was thinking, I could sit here and talk for hours around all this, and nobody's got the time right now, and maybe the patience, but it's complicated, but there's a process to all this. And I mean, just from, is your entity choice correct for an exit? What is a potential purchase price allocation that's going to give you the best tax result you can get? What about, and John will speak to this, but what about contracts and agreements within an entity that you can't transfer, that you're going to be forced into an entity structure? But some of the things that I love about an exit is that whole due diligence process, the process where, and generally we've been on the seller's side, okay, because we're working with businesses, they build them up and they sell them. So we're generally working on the seller side, and a good due diligence firm on a purchase, they uncover everything. I mean, there is not much left under the table, and just going from things like valuations on equity award units for employees. I mean, that's a big deal. They dig into, how did you get these valuation numbers? How did you run these things for tax purposes. Benefits, 401k plans. Have you operated it properly? Have you transmitted the the employee deferrals on time? And if you don't dot the I and check the box on all these things, it complicates it, and I'll turn kind of that over to John. John, what's your experience?
I completely agree with that. And then, I mean, you're right. We can sit here and continue to just identify things that they're going to uncover. I completely agree with that statement in terms of they're going to get to the bottom of things, but kind of continuing to identify things that I see pop up in diligence that's a problem that you can correct ahead of time. Are all of your employees or independent contractors classified correctly? If not, there's serious consequences to that. Do a self audit of your I-9 immigration situation, which a lot of companies don't do. Jonathan mentioned, audited or reviewed, financials, but related to that, and this is a lawyer talking using about accounting items, but are you on an accrual basis or a cash basis? Buyers hate cash basis accounting. And what will oftentimes happen is they will actually require your financials to be converted to accrual as part of the process of closing, which can change your numbers themselves and cause valuations to adjust. And even if that isn't the result, it's still time consuming and expensive. And so if you're going to sell your company in 3 years, convert now. You can get them reviewed or audited over the next couple of cycles, but you can also, at a bare minimum, be accrual versus cash, which makes, in my opinion, a huge difference in the process.
I totally agree with all that. And the other thing that just came to mind was when you're talking about things that need to be buttoned down is sales and use tax. We see buyers not wanting to get involved if there are states that you should be filing in that you're not. And so taking a hard look at that is another area that business owners can do.
And Jonathan, with that, the Wayfair decision on sales and use tax opens it up to, virtually almost every state you touch in any respect. You got to really look at it, and that's a great point. You got to get prepared for tax compliance, and you might as well do it sooner than later.
Thank you. Jonathan, with regards to valuations, are they all done in-house, or do you go to industry expert appraisal firms that have a better knowledge of particular industries?
If a business owner wanted a business valuation, I think using an in-house firm is totally fine, and we do that as well. We use the same methodologies and are looking at the same publicly available data metrics that other firms are as well. Again, I think that's a good first step to get a baseline for where your business is today. But remember, in the process, when you get to that point, we don't share business valuations or list prices or any sort of expectations of value. We let the market respond, and that way we're not stifling a potential spike bidder who would have paid higher than what our list price offers. But I do think there is a good use for valuations, and whether it's an in-house firm or a specialty firm, I think both would be fine.
Thank you. Lastly, last question from the audience. I'll leave this with you, Jonathan. Can you speak for a moment as to how things might look different if you are selling to a partner?
Yeah, so a partner is essentially like the internal exit option that we talked about. And there, you've got a very knowledgeable partner or a buyer on the other side of the table. And so in some ways it can be a faster process because there's not the same degree of due diligence and getting to understand and know the business as there would otherwise be. But there's also sort of the history and the pros and cons of having worked with that person over time. And so having a third party help to mediate that, whether it's an M&A advisor or an accountant or attorney, or just someone to help kind of bridge those gaps, have some of the more difficult conversations that are not happening directly. We often see the use of some type of third party versus the principals trying to knock it out directly amongst themselves is well worth it. And ultimately, you have a more successful transaction where both parties feel good about it at the end of the day, rather than feeling like one's been beaten up by the other.
Absolutely. Excellent. Well, that is the end of the questions. If there aren't any others, I'll turn that over to Clara.
Great. Thank you so much, Carrie. And thank you, Jonathan, John, and Mark. And thank you, everyone, for attending today's webinar, Prepare Well to Exit Well, a primer for business owners. On behalf of Transact Capital, Whiteford, Taylor and Preston, and SEMA Financial Group, thank you for joining us today, and stay well.